Okay, welcome to the January 30th edition of the Fats, Fuels, and Oils webinar. This week, I am guessing that people probably have questions about what's been going on in the RIN market. Last week, RIN prices were down 25%. The D4 dropped from 76 cents roughly to about 57 cents. It looks like the release of the EMTS data, which we'll go through today for December, the prior week, is the most likely explanation. Maybe I missed an announcement or something, and if I did, somebody please raise your hand. But I've talked to several people, and that seems to be the conclusion that everybody's come up with, that renewable diesel production in December was essentially enough above market expectations that RIN prices came under pressure. Now, I think there's probably a little bit of sort of technical analysis kind of driven reasons for the outsized move. If you look at the RIN price chart, it had sort of bounced off of 77.5 roughly, probably 3 times since I don't know, last year. And so I'm not 100% sure that this is what happened, but I'll kind of explain it to you like it was a stock. So in technical analysis in stocks, then that becomes sort of a support or resistance area, because people tend to psychologically look at those areas, and then if you're trading stocks, you set a stop loss order around that area. And what happens when you tend to push through them is you trigger a lot of those stop loss orders, and it accelerates the selling. So obviously, people aren't trading RINs on E-Trade, but still there are brokers involved. And if you call up a broker and say, "Hey, I want to buy a RIN," and after you've bought it, you say, "Okay, now I want to limit my losses to 77.5 cents or whatever." That's kind of theoretically how that worked. If you look at the actual decline, it kind of started a little below that level. So there are some problems with it. You don't typically use technical analysis to explain moves in markets that aren't sort of equities markets or futures markets, but there are some carry-throughs in very simple things like resistance and support levels. Tend to be more reflective of human psychology than they do of something that's specific to the individual market. And so even if the people that trade RINs didn't go through a broker and didn't ever say, "Oh, get me out if it falls below 77.5," their decision-making process was probably relatively similar in their own heads. And so I think that a combination of bigger than expected renewable diesel production, particularly it feels like over the last 6 months almost, maybe not quite that long, but over the last several months for sure, people have talked about margins and the pressure on the biofuel industry. And I think a lot of people sort of looked at the collapse in RIN prices as evidence of the weakness in margins. The reality is it should be the exact opposite. If RINs are an insurance policy on revenue, falling RIN prices mean that revenue is ample. And that's kind of what our margin estimates show. And so I think that one, I think this also looks a bit, well, let me say it this way. If I didn't have a prediction or an opinion on what next year's production looked like, and I was just looking at the chart, again, sort of a technical analysis thing that we don't necessarily do in these kinds of markets, but if I looked at that chart, it looks a lot like capitulation to me. So it looks like, and especially if there were a lot of sort of sell orders or people just sold naturally below 77.5 cents, you get a big move down, and that kind of flushes out the weak hands left holding RINs. Now, of course, the RIN market is different than a lot of other markets, and so this stuff I think it applies, but I wouldn't, if somebody came up to me and said, oh, I think you're completely wrong on that, I certainly wouldn't argue too much with them about it. Nevertheless, if it is capitulation, what you would expect to see is sort of RIN prices stabilizing a little bit and then starting to rally. Now, they may stabilize at a lower level, and yesterday's price action didn't give me any confidence that the decline is about to stop. So let's take a look at a bit about RINs, the EMTS data, and talk a little bit about where we think things are going. All right, so here is the ugly truth, really. This chart just shows RIN prices, and these are the 21, 22, 23, and 24 vintage back to back, with each one the price covering the year of its vintage, to try and keep things, to try and compare things sort of apples to apples. Although I'm not 100% sure there's a huge deviation between the price movements in vintages, at least right now. There certainly isn't. And you can see certainly the lowest RINs have been since 2021, 2020, and actually sort of, if you look back through history, it looks to me like 2018 was probably the lowest price that we've seen since 2017-ish. So RINs may have traded below 32 cents in 2016 or 15 or back to 2011. And I will gather all of the historical data. Right now, we only have the historical data back through 2017. I think I always assumed it was on our website, but I haven't been able to find it. So I'll pull that up and we'll look at it. I bring that up for two reasons. One, to kind of point out where we are relative to history, but two, then to talk a little bit about what happened in 2018 after prices dropped to 32 cents. And in 2017, RIN prices were above $1. They were like $1.15 or something. And then they started to, much in the same way they have over the last couple of years here, just steadily decline, steadily decline, steadily decline. And I think part of that may have been, part of the rally in RINs may have been in reaction to, and I don't remember this specifically, even though I was covering the markets, but it may have been in reaction to, if you remember, about that time, the US sued Argentina and the World Trade Organization and implemented import tariffs on biodiesel imports from Argentina. And so maybe that the buildup of that sort of lifted RIN prices, and then they spent the next couple of years sort of working their way lower. Anyway, after 32.2 cents, RINs, and it's the low, so you already know the punchline, RINs started to move up. Now, not very quickly, and it took a while before they really sort of rose back into kind of where the long-term average was around that time, which was probably a little bit above that, probably 65 cents or so. And then they rose, and then they kind of stabilized where they were, which is kind of the classic. When you think of capitulation, that's sort of exactly what you think. Like, the fundamentals have triggered a significant round of selling, and after you've exhausted that selling, you get a little bit of a relief rally, and then maybe you settle just a little bit lower into an equilibrium range, or maybe the equilibrium range is where the rally ends. Whether that happens this time or not, I think a lot of that will depend on, of course, feedstock prices primarily, and then the supply of RINs. I think after last year, after thinking about it for most of the year and talking to a lot of people about it, I went back and forth between whether RIN prices are really driven by the supply and demand of RINs or whether they're really driven by feedstock costs. And given what we've seen in RIN prices, feedstock prices, fuel prices, the price of everything over the last 3 years, I think it's reasonable to assume that a significant portion of the decline in RIN prices is just all of the markets recovering from an inflationary impulse. And then, of course, there is oversupply, and we'll talk about how much we think 2023 was oversupplied based on the EPA data. But I don't think the oversupply was as egregious as a lot of people in the market thought. And maybe part of that is just because I'm tainted, because before the pandemic, the industry routinely carried over billions of RINs, and it was always a question that I had in the back of my mind is, why are these companies carrying literally billions of dollars on their balance sheet for no real apparent reason? It does seem like the shift to renewable diesel has brought more discipline in terms of the RIN bank. And so that probably also, or I think it's probably hard to say that that the oversupply of RINs in 2023 didn't have anything to do with their prices breaking. And I think in particular, because if you look at the total RINs, it's not that far off the mandate. But if you look at the D4, and we'll go through all of that, the D4 is multiples above our calculated mandate. So the mandate the EPA announces, plus the undifferentiated advanced mandate, plus the ethanol gap. Our estimate is that that RIN production under D4 was well above the volume required, even after you add in all of the other little spots where you can, or not so little, but the other spots where you can use D4 RINs, or at least you're generating D4 RINs to meet the gap, even if you sell the D4 to buy this D6 to meet your mandate. And so I think that that as we look forward, and using a bit of history as our guide to smooth the models, I guess, a little bit. At this point, the models are really, they're not confused, but they're maybe more bearish than a lot of people in the market, given what just happened and to prices. And so the models, in particular the D4 model, would like to predict prices that are lower. The D6 is kind of fine right around here. And so we lift the D4 above the D6 a little bit. Otherwise, the D4 would forecast a little lower, because next year looks like a very close repeat to this year, except more renewable diesel capacity and a change in the mandated volumes. All right, so let's talk a little bit first about the EMTS data and what the EPA said about biomass-based diesel production in December. Sorry. So December's production was up pretty sharply, particularly for renewable diesel, which set a record at just under 410 million gallons. It doesn't seem like it's the same kind of sort of seasonal increase that we used to count on for biodiesel every year. That doesn't seem like the reason that that December was up relative to the rest of the months for biodiesel. And it was up, but it's 16 million gallons above the previous record that was set way back in May. And so it's not a it wasn't that much of an increase in domestic production. I guess if you look at the combination of the two, you get up to 523 million gallons versus 488, I guess, in May. And so that's 10% difference. That's significant in total supply. But there's nothing in this chart that looks really crazy to me, or looks like it would trigger a 25% reduction in RIN values. Yeah, the oversupplied in December was a big production month. The way that I kind of think about this stuff is what changed between 2 weeks ago and today that made RINs worth more than 25% less. That's a huge cut in a relatively short time. And if it really is just the EMTS production and sort of the idea that volumes are going to continue to increase from here, and there are some uh, really large facilities that are expected to open next year, even as other facilities are running into issues with financing and environmental groups and all the kinds of issues that you run into anytime you try and do a big project, but particularly if you're trying to do a big project in the energy space. Uh, and so I think that that's the expectation that whatever the RIN bank is, even if it were just 1 billion RINs, that we're not going to get back into underproducing RINs anytime soon. And so it's hard to be really constructive on the outlook for D4 RIN prices. In D6, kind of the same. I think the D6 market to me looks, I know it's ethanol, but it looks to me like again, sort of a repeat of last year. The one thing that I think might have changed a little bit that might have some impact on D6, although I don't think it's going to really be significant, is there does seem to be a bit of a slowing in the adoption of EVs. And so from that perspective, maybe people get a little bit more bullish on ethanol, and maybe we get a little bit of separation between the D4 and the D6. However, our numbers for 2024 really do look eerily similar to 2023. So it's extraordinarily hard and disingenuous for me to sit here and kind of try and pretend like 2024 is going to be vastly different. I think we're going to have a very similar year this year as we had last year. And that's probably a good thing, because in 2025, who knows what's going to happen. So this is biofuel production in gallons relative to the mandate. And so you can see for 2023, biodiesel or biomass-based diesel, not even that, biofuel production across all the fuel codes, sorry, was relatively close to the mandate, maybe a little bit below just in terms of gallons. And you can see, but not as, but either way, closer to the mandate than we were last year in terms of gallons and many of the prior years. And so from that perspective, I think if you didn't know much else, you could argue, hey, we didn't overproduce that much, and so RIN prices shouldn't be that low. However, the chart that I showed a bunch of times, it sort of had all of the biomass-based, or all of the D4 production, I guess, and then it was, and then I showed the implied mandate for D4, and then there were 2 bars, and the other one, I should have just put the chart in here. The other one showed the overproduction of D4 relative to the mandate. That one said 894 million gallons this morning, and so it's understandable that the D4 RIN could be under pressure given that excess supply. And particularly when you add in all of the other factors, the inflation impulse and the expansion of renewable diesel capacity and all of the little things that we've talked about have all sort of combined to press RIN prices down as much as they have. However, but is also just the total RIN supply. So if we look at the total RINs generated from that volume of production, you can see that this year in particular, especially relative to the last couple of years and really relative to a lot of the history, we overproduced RINs significantly relative to the mandate, or the volumetric mandates. And again, and this is This is sort of around the edges. The volumetric mandates that the EPA announces and that we work with all year aren't really the mandates. Each individual obligated party gets a portion of their fuel that they need to blend. And so greater or lower fuel use during the year can raise or lower the individual mandates. But we talk about these and they're a good proxy. But right here, you can see very visibly why I think if you think about, well, the total supply of RINs was greater than required. And then in particular, the D4 was really the main contributor to that. It is it's too much supply. And so there we get back to the, is it feedstock cost or is it supply? If you look at this chart, it's very hard to argue that it's not supply. However, I'm leaning back more towards the feedstock cost camp, in particular, because I don't know that the actual excess total RINs was that substantial. And I guess theoretically, even if you produce a D4 RIN in lieu of a D6 or in anticipation of selling it and then getting the D6 RIN, you still are producing, the RINs there. And even if you don't necessarily use it for D4, you still have to sell it. And so I think that part, when it's 894 million gallons worth of RINs that are of excess RINs, that again, then are probably, if it's 894 million gallons, that's 900 times 1.6, essentially. That is like 1.54 billion gallons or 1.44. My math there is not so good. Either way, it's well over, and when you combine that with the total overproduction of RINs relative to the mandate, then it becomes easier to say, well, obviously it's the supply. We'll see what happens here, and if we get a bounce in feedstock costs like we expect in the second half of 2024, and RIN prices don't recover with feedstock costs, then I guess I'll come on here and I don't know what I'll do. I'll put up a big sign, I guess, that says it really was a supply. There will be enough people in my life that will constantly remind me that I ultimately said it was the supply and not feedstock costs, that whatever I would do here would be just minorly embarrassing relative to that. So what did the feedstock use look like? I like this chart because it really easily shows you kind of what feedstocks are gaining and what feedstocks are losing market share in the feedstock mix. And so the easy takeaways here are not surprising, and you don't need to listen to this webinar to learn this, but soybean oil's portion of the total feedstock mix is going down. UCO, yellow grease, and other fats and greases are going up. If anything, the decrease in soybean oil is probably faster than this chart reflects, because on the right-hand side, the purple numbers are forecasts, and you can see there's a bit of a jump there for a couple of these things where soybean oil, instead of 37% in December, or I guess it's actually September, we've got it going up to 45% sorry, that was October. We've got it going up to 45% in November. That's probably a little optimistic. And on the opposite side, inedible or tallow we've got it 8%, it's 15%. So there will be some adjustments there, but I think broadly, it's not a surprise to anybody on this call that vegetable oils will increasingly come under pressure, particularly with the shift to the Inflation Reduction Act credit and low CI feedstocks to the extent that the industry can increase the supply will increasingly count for a larger percentage of the feedstock mix. Now, the one question here, one of the big questions here is, especially as we sit here next year, will be if we do switch to the blenders or from the blenders tax credit and it doesn't get renewed, it implies a significant cut in revenue for the industry. And it doesn't look like soybean oil necessarily qualifies for any of that tax revenue or that tax credit revenue. In it, again, you could say, well, we'll just quit using soybean oil. But just based on this slide, that looks particularly difficult, especially given that the supply of fats and greases is fixed or relatively fixed. We've increased imports a lot. I think that's a good sort of short-term solution, but I think in the longer term, that's probably going to ultimately be a little bit problematic if we start to rely on those volumes to produce biofuel, and then developed countries start to announce their own mandates, and that additional feedstock gets locked up in domestic industries using it to produce SAF. In the short term, though, it looks like we can increase imports, and so soybean oil probably, our percentages are probably a little bit optimistic there, and probably a little bit pessimistic on the fats and greases. This is just what it looks like in terms of actual volumes. And again, you see the 1.25 essentially billion pounds for December. Maybe that's a little optimistic. December volumes were up, and so I think feedstock totals are up. It's just a question of whether that feedstock was soybean oil or it was something else. And then again, the question with UCO really is how high can we go? When we talked about UCO, and I showed that slide of shipments to Europe and then to the US, and it kind of implied that essentially China is shipping all the UCO that they can right now. If all of that ultimately ends up coming to the US, or China increases their capacity so that they could ship that volume to the US, then, as I said a couple weeks ago, it would be another 2.2 billion pounds of UCO supply that could be added. It still isn't enough, though. I mean, it's 13.1 billion pounds that you have to replace. So even if you did that, you still would have 10.3 billion pounds, or no, not even 10.9 billion pounds of additional feedstock you would need to source. And so if there is, to sort of bring it back to RINs, if there is a bullish story to craft for RINs, it's probably not 2024, but it is 2025 when imports quit getting the credit, no matter what feedstock they use, and veg oil essentially stops getting the credit. But you can't take veg oil out of the feedstock mix because it's a significant portion of the total, and so that kind of leaves RIN prices to encourage the use of vegetable oils to meet the mandates. Or I suppose LCFS credit prices or the IRA credit, to the extent that it'll trade, may also rise to reflect the need for vegetable oil in the feedstock mix. It's difficult to say how much that'll be, or what the impact of that'll be. Part of it will depend a lot on what the feedstock mix looks like at the end of the year, and we'll start to dig into that a little bit more as we get closer. But it's always been, I've never really thought that we couldn't use soybean oil and meet the goals of the program, and I think that that trying to do it without vegetable oils will delay and make getting to where the administration wants to get to. It'll just make everything take a little longer. Maybe in the end it'll be a more solid footing, but I don't know that I necessarily think that that's true. If you're just relying on a fixed supply feedstock, if something happens to that supply, you're in big trouble. And it's not like we're going to quit farming soybeans, so there'll always be soybean oil around. But I think that by the time we get into 2025, well into 2025, and we have strong opinions about what we think is going to happen going forward, I think that the changes from where we are today probably are not quite as intense as you could talk about them, as you could reasonably talk about them being, I guess. Okay, so this is our RIN price forecast. Getting those two lines to move apart is tricky. And until the ethanol gap goes away, it's tough to forecast them separately. The models really wanted to do it in December, and I didn't mess around with it too much because December was really the first month where the models lowered ethanol production, but they didn't, or lowered the D6, but didn't have the D4 pressing down on it, essentially. So I don't necessarily think that that gap's going to be there when we get there, and I'll probably tighten it up in the coming weeks. But I think that at least based on our forecast right now, there is some chance that we get a small separation between D4 and D6 by the end of next year. Maybe. Either way, it doesn't look to me or the models like RIN prices are going to rally anytime soon. We've got them down a little bit in February in the final capitulation, I guess, and then starting to recover. But I think probably until we sort of have a good idea of where the bottom is, I think it's going to be tough to estimate it or predict it, much in the same way when the LCFS credit was falling, and I kept saying, well, maybe 70 will be where we stop, or maybe 100 will be where we stop, and we didn't stop until we were lower. And so maybe that's the way that RINs will be, but it doesn't seem like there is a ton of space below where the market is right now, based on history. So one of the things contributing to the increase in RIN prices, and this is something that I think is probably really obvious if you think about it, but it was something that I hadn't, I guess, thought that much about. And then when I saw it, I thought, oh, this is kind of interesting, but also sort of a bit obvious, but I still wanted to share it. If you look at the implied RINs per gallon for D4 from the beginning of the program to now, the average RINs per gallon of D4 production have risen from 1.5 to 1.6 in 2023. And we predict 2024, the average will actually be 1.62. This is important in a couple of different spots. One, it just kind of talks about, or just kind of demonstrates for the same volume of production, we're getting, another 1/10 of a RIN or so at this point, and that starts to add up when you produce 5 billion gallons of fuel. And the other is, this really highlights the shift in the production mix to not necessarily away from biodiesel, because we actually produced more biodiesel last year than we did the year before, but certainly to include more renewable diesel in the mix. If we were eliminating biodiesel as well, I think that that the increases would be even more stark. But I thought this was, like I said, I don't think that this is anything that anybody couldn't have figured out if they thought about it. But I did think it was kind of interesting, just because it is relentless in going up pretty much. All right, so our forecast for biodiesel production and biodiesel margins. And so you can see we still have production essentially kind of unchanged from the last couple of years, down a little bit, certainly not down as much as we did earlier in the year, or very early in the year. And it looks to us like margins are going to remain well supported through the first quarter for sure, the first half of the year maybe, and then in the second half of the year, the assumption we have on energy keeps energy prices at or below the current levels, and then the rise in our expectations for feedstock costs start to weigh on margins. And I don't know that we'll get all the way as low as we predict by the end of 2024, but it does look like there will be significant pressure on margins, and in particular, probably biodiesel margins. One of the interesting things as we come up to the end of the year will be to see what biodiesel producers are going to do. They can hedge their feedstock costs and their production a bit, and that can allow them to stay open longer than they would have if they were just doing spot. But I am sure that the senior management at all of these firms are and have been planning for this for as long as I've known about it. And so you may see an increase in corporate announcements in the second half of the year. So maybe you'll see companies closing down or selling themselves or merging. That's the kind of thing that I'm talking about. And if we're in a situation where margins are compressed because energy prices are where they are now, essentially, and feedstock costs start to rally again, then that'll only accelerate the pressure on senior management to find a good exit for the biodiesel producer if they don't believe that they can produce biodiesel profitably going forward. I still believe this firmly that there are opportunities for biodiesel to continue for biodiesel producers to continue to remain in business. And I think if done correctly, I think they can also maintain their margins. But I think it's difficult, and I don't think that every biodiesel producer is going to survive. So I think, again, I'm sure the senior management at these firms have been thinking about this and planning for this for a while. And I think we'll start to see the results of some of those plans, certainly in 2024. And then I think all of that stuff just accelerates as we get closer to the end of the year. Renewable diesel, we've got production continuing on the trend up there. That is a pretty nice trend line. We've got November and December down a little bit next year. That's a little bit more of the history weighs on it as much as last year, essentially the 4 years prior to that. And so that's why we have that little decrease there at the end. I probably will go in and clean that up a little bit and raise those a bit and cut some of the other ones down a little bit. But again, I don't think that there's a lot of seasonality in renewable diesel production. So I'm not too pressed to really get in there and start messing around with the individual months, because I think we are, at least I am, still learning about exactly when biodiesel production surges and falls. And seasonality is not the easy trick like it was in biodiesel. The margin outlook is similar, however, because renewable diesel prices are again sort of at a discount to biodiesel currently, and we have kind of extended that discount a little bit given the frequency that it's happened over the last couple of months, or over the last year and a half or so. And so the increase in sort of Q3 margins there is really steady to slightly rising renewable diesel prices, based on the idea that relationship goes back to renewable diesel trading at a premium at some point. We kind of build it up slowly from the current deficit, and so that helps support renewable diesel prices and margins. Again, it wouldn't necessarily surprise me if the margins were a little bit higher in the first half of the year than we have, but then that don't go up quite as high to that peak if the whole thing was just a little bit narrower this year. I think that from a market perspective, from a from a price perspective, I'm not sure that we're going to see the same volatility this year that we've seen the last couple of years. In fact, it would be really hard to repeat the same volatility that we've seen the last couple of years. And so that's part of the reason that I say I think this will probably be a little compressed relative to what we're showing here. But it's still in the same general direction. All right, that is it. And some of you have been kind enough to ask some questions, and I am more than happy to answer. It's an interesting point. So the point is that if you look at the timing of the decrease in RIN prices or the accelerated decrease in RIN prices, I guess, it coincides a little bit more closely with a press release about some entities that are suing the EPA, claiming that the RFS is illegal and unjust. Maybe and people probably know who the company is, but I don't want to say them in case people don't. I don't want to disparage anybody. What I generally think about that is that there have been a lot of attempts over the years to just reduce the mandates, let alone scrap the whole program because it's illegal and causes economic harm, I suppose. I don't think that there's much chance that that is actually going to come to fruition. Maybe it will. Maybe I'm blinded because I work closely with the industry. But it's not. This isn't. It's not a new policy or a new program or one that hasn't been tested. I mean, I tend to think that if I worked at the EPA, the solutions that I would go for to some of these issues are, how can I get sued the most, essentially? Because they're going to get sued one way or the other, and if both sides are suing you, then that's probably a pretty good compromise. So it's not like the program hasn't been tested legally over the years. So I don't know. I again, maybe I don't know much about this, but maybe they have a novel legal theory, or maybe they have a lot of money, or maybe they have some other reason that they're really confident that that's going to happen, and maybe they'll be able to actually make it happen. I think that's a real low probability, but potentially, I suppose. Whether that broke RIN prices or not, boy, it's hard to imagine that the combined probability of everybody in the RIN marketplace for that would be so high that they all would say RINs are now worth 25% less the next day, or not quite the next day, but the next week. I mean, that could theoretically happen, although again, I think it's probably relatively low probability, because essentially what that would be saying is that everybody thinks that this thing is worth a quarter less, or 75% of its value from last week, because of a legal case that seems unlikely to be successful. And even if it was, probably would take several years to wind its way through the court system. So it wouldn't have an impact on RIN generation or on the program in 2024, or probably until 2025, 2026. I suppose they could get an injunction or something like that. But if the repeal of the whole RFS seems unlikely through this process, I would say an emergency injunction seems even less likely to me. So I'm not an attorney, and so my legal opinion is not worth anything at all, not even the air that I used to form it. But just based on my experience with the industry and the number of times that the EPA has ended up in court with one of the sides It seems unlikely to me, and it seems less likely that it would be the cause of the break. But again, I think particularly when you are around some of those areas of resistance and areas of support, there have certainly been weirder things that have triggered sell-offs in markets than that, which is it's an unlikely, but it's a legitimate threat. If it's successful, it will be a legitimate threat. But I think it's a very, very small probability that that actually is successful. So somebody is asking about where the blender's tax credit applies. And they're taxing my blender's tax credit knowledge, honestly. So essentially what they're saying, and maybe if somebody knows the answer to this, if you could type it really quick, that'll make me look smart. So they're asking, we want to sell biofuel into a very specific market, and they've heard that in that market, the blender's tax credit doesn't apply. And I honestly do not know, but I will figure that out, and I will get back to the person that asked this question specifically, and we can talk a little bit about it. I'll tell you what the answer was next week when I get through it. My gut is I thought that it applied across the board, but again, I could be wrong on that, and I have not specifically looked at the situation that you're asking about. So let me dig into that a little bit, and then I will get back to you. And almost made it 3 minutes. 3 minutes. All right. Thank you so much for the questions this week, and thanks for your attendance. And I hope everybody has a great week, and I will see you next week. Bye-bye.